Good morning, traders. How is everyone doing? I hope you've all had a fantastic week, a very disciplined week, and having a great week in the markets, enjoying the price action as always. We're back today with another trading psychology session, and actually a fundamentally important one to improving your overall trading psychology. Now, today, as you can tell by the title of this session, I want to discuss the importance of accepting uncertainty in the session. Apologies, 1 second. Okay, apologies for that. So, as I mentioned, as per the title of today, I want to discuss a very important topic, and it's all about the idea as traders for us to be embracing the idea of uncertainty in the markets. Now, from my experience, both in my own trading journey and discussing this with hundreds of traders around the world, being able to truly accept the uncertain nature of the markets is one of the hardest things that we have to do in terms of us being just human, regular people. And it's actually one of the most common issues that traders struggle with. And it goes on to impact their performance in a variety of ways. Now, the reason it's actually such a difficult one to conquer is most people aren't even aware that they're suffering with the idea of not fully embracing the uncertain nature of the markets. So I think what would be great to clarify right at the start of this session is what specifically do you need to look out for to help you understand if you are someone that is not truly embracing the uncertain nature of the market. So I've written out a few things here that I look out for as a coach that I try and spot in aspiring traders to help them identify that actually this is a problem that they are suffering with. And then we'll move through the idea of why it's such a difficult concept for us to fully embrace, and then what we can do to start to fully embrace the idea that the market is uncertain and overcome it and actually profit and extract money from the markets. So, a few simple symptoms that for me trigger sort of alarm bells and red flags that somebody is suffering with not accepting the uncertain nature of the market. Constantly changing your strategy is one of the main ones. This was one I was guilty of for the first 6 years of my trading. And I spent going around in a vicious cycle trying to break free of this. And it didn't truly, I wasn't able to break out of that cycle until I fully accepted and realized I was not fully embracing the uncertain nature of the market. So if you are someone that is constantly second guessing your strategy, maybe you're someone that is constantly trying to refine and tweak your strategy, that could actually be a fear of the uncertain nature of the markets hidden deep within your subconscious, which is manifesting in a way in which you think you're doing good, but actually it can be quite harmful for you. Some other ways that it develops in traders, they often move their stop losses. They are frustrated after taking losses in the market. They are the first ones to blame external factors, news events, politics, scheduled events that are happening around the world, correlation to the US dollar, correlation to the Japanese yen, many other external factors. Um, Sometimes you see these particular traders, they often try and seek assurance in their ideas about the market, maybe from online or analysts, Bloomberg, whatever it may be. They're looking for certain ways to confirm that their idea about their particular trade that they have is correct. That's often one of the ways in which they don't embrace uncertainty. And one of the last ones, which I think is actually quite a big one that I've noted down, is looking for perfect opportunities. I hear many times traders speak about only taking A plus setups, right? And whilst I understand that every trade has a probability of playing out based on the experience and back testing that you may have done, actually, the one thing that you have to accept when it comes to embracing uncertainty is that there is a chance that any trade that you take has an uncertain outcome. And that means it's hard to know right from the very beginning whether there is a high probability or a low probability opportunity, because the keyword is just that, it's probability. Okay, we're simply trying to stack odds on our side and doing our best to manage risk. And risk is a key part of this and a key part of what we should be focusing on. And I'm going to discuss a lot more of this as we move through today's session. So, for anyone that has attended my sessions previously, you'll understand that the gap where I feel there is a lot of missing knowledge is understanding specifically how the mind operates and why it operates in the way that it does. So, you'll understand that a lot of my sessions, I usually start the session by explaining a little bit about the psychology of why we feel the way we feel and then why we go on to act in certain ways, and understanding and helping people unlock why we do certain things and why we feel certain things is usually the key that they need to help them go from identifying a problem to actually resolving that problem and not just being stuck in a continuous cycle. So I want to start right from there today, where we discuss why is embracing uncertainty so difficult, right? Because like I said, this was something I suffered with for 6 years until I fully figured out and accepted the idea that I will never fully know what is going to happen next in the markets. So why is it so difficult? Well, I've written down a few reasons which will all stack together to culminate a big reason as to why it's difficult for most humans to accept uncertainty. The first one I have written down is the human mind is generally wired to find patterns in everything that we do on a day-to-day basis. Now, the reason this is important to highlight right at the very beginning is because the mind is such a complex piece of, I guess, machinery, if you want to call it. And the way in which it works and the way in which it can take in the amount of information that it does and make assessments and judgments and tell you what is best for that certain situation, it does that efficiently by creating patterns and links in what we do. When you were a child, if you came into a situation where you touched a hot iron, your mind will ingrain that experience with a lesson in that if the iron is on and it's hot, it's not a good idea to touch it. And that experience will be ingrained throughout your life, through many other experiences growing up, where you see that the iron is hot, you start understanding its temperature, the damage that it can do to us. But that is a very simple explanation at helping you to understand that our minds are simply wired through experiences and beliefs that we've got from either our external environment or the people, our family and friends around us at a very young age. So that is fundamentally how the mind works. It's constantly looking for patterns. So specifically as a trader, why is that important to know? Well, the majority of traders nowadays, they tend to sway more towards having an approach which helps them pick and identify positions based on technical analysis. Now, if you understand the idea that your mind is constantly trying to find patterns in everything that you do, technical analysis is almost these days entirely based on that idea, right? Everything that we are trying to do is trying to find repeating patterns in the market. Now, technical analysis can be a fantastic tool, and it's one that I use day in and day out as a trader. However, the thing that you have to remember is that if you are open to the idea of fully embracing that the market is uncertain, you have to understand that technical analysis, in the sense that we use it, is flawed because it gives us a false sense of reality of what may come next. What tends to happen is traders build such confidence around a certain system, and actually it borders on the edge of overconfidence, that they believe they have some insider knowledge that they know what will happen next. If you are to truly embrace the idea of uncertainty, you have to understand that the reason you place a stop loss, the reason you don't risk 100% of your account on any given position, is because there is a certain part of you that understands you never truly know what will happen next. And technical analysis is one of the ways in which our minds are tricked into thinking that we may know what is to come next. Okay, so our minds are wired to find patterns, and the more you look for something in the charts when you're doing your technical analysis, I promise you this, the more you will find it. Reason number two, why embracing uncertainty is so difficult. There is a big fear of the unknown. Okay, I see this time and time again, and it was something that I was first exposed to when I started off my career in coaching, but working as a life coach. I found that the majority of people on a day to day basis tend to stick within their comfort zone. They stick within their safe bubble and they do things day in and day out, which are repeatable and they are familiar with. Therefore, trying to explain the idea to an aspiring trader that you're trying to get involved in a market and actually trying to make money from a market in which you have absolutely no idea what will happen next can be a fundamental problem. Okay. So fearing the unknown and branching out of your comfort zone is inherently something that many people suffer with. It's not something that everyone does. Some people are more outgoing and open minded to certain scenarios, and they're actually happy to put themselves out there. But in the majority, I would say largely most people have a fear of the unknown and prefer to stay inside of their comfort zone. Reason number three, confirmation biases. Okay. This is one I've actually done an entire session on, talking about some of the main biases which affect us on a day-to-day basis. Now, whilst I'm not going to go into all of the details in terms of every confirmation bias here, I will give a brief demonstration for anybody that hasn't seen that previous session which we held. Now, a confirmation bias is simply an error in the way that we think, perceive, and interpret information in the world. And this can have a huge impact on the decisions that we make on a day-to-day basis for our trading. Okay, so understanding that the mind has errors in the way that we think is going to impact the decisions and actions that we make as a trader. And actually, all of those biases working against us, again, often make it difficult to truly accept uncertainty as a trader. The last one, and this is one that I refer to a lot when I speak to traders, because I think it's an idea or a concept which people can actually fully understand right from the very get-go. Now, generally in life, we are taught that certain input has a fixed output. Now, what do I mean by that? The best demonstration I could give to explain what I'm referencing here is think about the idea of karma. Okay, most people that have been brought up with the idea that if you do good things in life, good things will happen to you. And on the flip side of this, if you are a bad person or you take bad actions, then you're led to believe that there will be a negative consequence at some point down the line. So the whole idea of karma is that a certain input leads to a certain output. Let's take another example. Exercise, for example. Okay. In exercise, you're taught the idea that if you have a balanced diet and you exercise regularly, you will eventually get fit. And I would say in 9 cases out of 10, as long as you're following those principles and you have a good process behind you, that is very likely to be true. Okay. But again, fixed input, fixed output. And the last one that I like is working hard. Okay. We're generally taught if we work hard, if we put our head down and we focus on any single given task, at the end, there will be a fixed reward. Now, the problem with this dynamic is this doesn't exist in trading. In trading, you could show up on any given week. You could do everything right in terms of implementing your plan, which you may have back tested for days, weeks, and months on end. And you may face losses every single day that week. And that is the true uncertain nature of the market. But the way our minds are wired to believe and look at the world is that if we do good things, if we work hard, if we follow a strict process that over time is shown to make us money, then we should be rewarded from that. And in the long term, that may be true, but in the short term, because of the uncertain nature of the markets, that dynamic simply doesn't exist. And again, it works in a way which we've been conditioned from early childhood. And this makes it very difficult to break free of, whether we know it on a conscious level or whether this is something that operates in our subconscious. Okay, so just to recap, it's difficult because our mind is wired to find patterns in everything that we do. Most people have a general fear of the unknown. We suffer from many cognitive biases which hold us back in our day-to-day life, especially as a trader. And we're generally taught in life that a fixed input has a certain output. So that dynamic not existing in trading makes it difficult for us to truly accept the uncertain nature of the market. Now, the next topic is quite an important one. And I guess it's the reason that most people will be tuning in and actually watching this session. We're going to be covering 3 different ways at how you can actually walk away from this session a little bit more informed and how you can start to embrace the uncertain nature of the markets. So the first tip that I give most people is I approach them with the analogy of you can't be what you can't see. Okay, this is the first way to start accepting and embracing the idea that the markets are uncertain. You can't be what you can't see. What do I mean by this? Well, I mean, as humans, we generally learn through exposure. Okay, so exposure in terms of your trading ability and your edge actually comes from analyzing your particular strategy over time. Okay, that's how you build confidence in knowing what you do works because it's trusted and supported by data, numbers, statistics, right? These are things that cannot lie, cannot be subjective. They either work or they don't work in the grand scheme of things. And these are things that you can actually use on your side to help you support the idea that even though the markets are uncertain, we can still make money from them. So, how do you actually start to analyze your edge to embrace the uncertainty of the market? Well, what I advise most people to do is to go through an exercise of back testing of at least the last 12 months in any given market that they trade. And that sample size should include at least 100 iterations of your particular strategy in the markets. Now, where most people go wrong, or I should say, what most people choose to focus on when they do back testing, is they focus and they are looking for times where patterns repeat themselves and they see their edge play out over and over again. Now, this is actually a fundamental part of backtesting, and of course, that element needs to be in there. But what people miss with that is I take you back to the first stage of why I explained embracing uncertainty is difficult. And that is with the idea that our mind is trying to find patterns in what we do. And if the only thing you are focused on finding are times when your pattern plays out over and over again, all you are doing is simply ingraining into your mind that I am confident in what is going to happen next into the markets. So when you do this phase of your back testing, things that I actually want you to focus on are losing trades. I want you to find specific examples where in any particular market, the conditions have been met for you to execute your edge and they did not work. Okay, I want you to find specific trades that fit your criteria but would have lost you money. On top of that, I also want you to find periods where you go through drawdown. Okay, because if these are things that you cannot identify in backtesting, it's very likely that you are being too selective with what you are doing because it's unrealistic to expect that when you go live. Okay, if anything, when we go live, we are imperfect beings. We're likely to make more mistakes than normal. And expecting losses and drawdown are simply just part of the game. And the best way to help ourselves manage those periods are this whole idea of you can't be what you can't see. You need exposure to losses. You need exposure to going through drawdown and what that period of time looks like for your strategy. So you should know what is the typical period that I will go through a period of underperformance, because every strategy in the world has certain conditions which do not fit that particular market environment, right? You may have a strategy that works fantastic in ranging markets, but gets absolutely torn apart in trending markets. And that's normal, okay? Completely normal. So you need to understand that there are different market environments in which your strategy will thrive and different market environments in which it will not do so well. But seeing that through experience in terms of your back testing is important because it helps prepare you for what the market may potentially hold in your future. Now, one of the things that I like to focus on from back testing, apart from looking at your periods of losing trades where your edge doesn't work and looking at the periods of drawdown, is actually once you've got a good, healthy sample size of what your setup looks like, I want you to actually calculate what your win rate is. Now, I find this quite an important step because I find people all the time approach me and they say, I might have a 30% or a 40% or a 60, 70, 80% win rate. And what you have to understand is that win rate has to be extrapolated over a larger sample size. So even if you have a strategy which has, let's say, for example, a 60% win rate, you have to understand that 40 times out of 100, you are going to lose. Okay, it's guaranteed almost to happen in that way, if not more, when you go live because of the other psychological factors which may weigh in on you. Okay, 40 times out of 100, you may lose. Now, what makes that a little bit more difficult is I remember reading this first in Trading in the Zone by Mark Douglas, I would say the Bible of trading psychology. There is a random distribution between wins and losses in the market. So that means there is a probability that those 40 losses could happen entirely in a row. It's unlikely, but it's possible. Okay. So imagine you did all this testing around your strategy, you know it has a 60% win rate. And the moment you go to execute your first 5, 10, 15 trades in a row go for losers. How do you cope with that? How do you deal with that? Okay, so understand that your win rate has to be extrapolated over a large sample size. And I'm talking hundreds, possibly thousands. And to give that as, use that as your expectation of what is to come in the markets. Okay, expect that you're going to lose a certain percentage of the time, but don't use that number as a fixed percentage. Use it as a real number. 20%. If you're going to lose 20% of the time, you're going to lose 20 trades out of 100. You're going to lose 200 trades out of 1,000. Okay, so that's a more realistic way to look at your win rate and how to use your back testing to help you embrace the idea of uncertainty. Tip number 2, take back control. Okay, this is one of the most important steps that I give many people, and it's understanding the idea that your edge is not actually based on a repeating pattern. Okay, if you actually break down the dynamics and the maths around how most people's edge actually works in the market, it's usually not based on some magical pattern that they've discovered. It's usually their edge usually puts them in a position where they allow them to efficiently use risk to have a small downside and a larger upside, which mathematically over a given sample size of trades will put them on top. They will have a positive return on investment over that given period. So to take back control, you have to understand that if the markets are truly uncertain, then there is no certainty in terms of what you are doing in implementing your trading strategy, because there is always a chance that you can lose. Now, it's hard to feel like you're in control when you're playing a game that is so outside of your control. So the reason I started with the idea that your edge isn't based on a specific strategy, your edge is based on your risk management, because your risk, regardless of what happens in the markets, your risk is usually something that is always within your control. Okay, you can always control your downside on every trade by ensuring you have a stop loss in there. Does that make sense? You can always control your downside. You never know what's going to happen in the markets, but you can always have a limit on how wrong your ideas can be and how much they cost you financially. What I tend to find is people tend to experience stress in the markets when they relinquish control. When they feel like there is nothing they can do in a situation, that's what gets them most frustrated. And if you're thinking about trading and the uncertainty of the markets, there is no control in that environment, absolutely zero. So the best way to take control is to focus on the things that you have control over. And one of those things is risk management. Now, I actually tweeted this yesterday as I was brainstorming the content for today's session. And the tweet that I actually wrote out was, traders never really know the outcome of any trade. We must accept the uncertain nature of the market. If you can't guarantee the outcome, then your job isn't to predict price. It's to place bets with asymmetric risk to reward. The edge is in your risk management and not in your analysis. And that is something that I truly choose to believe. I don't believe there is any level of analysis that you can present me which will guarantee the outcome of your next trade. Therefore, the only way to control that situation is to focus on what you fundamentally can control. And that's not the markets, it's not the news, it's not politics, it's not economics, it's not natural events and disasters. It's controlling your risk within the markets. Okay, so that's step 2, taking back control. The third and final step is to create a perspective shift in your mind. Because when I talk to most traders about embracing the uncertainty of the markets, everyone perceives this as a negative. Everyone perceives that the uncertain nature of the market is a bad thing because they have no idea how to predict what is going to happen next. Well, actually, I want to present a perspective shift on that. And I want you to think about this a little bit differently. What if uncertainty is an opportunity? Just think about that for a second while you listen to this. What if uncertainty in the market is an opportunity? Now, how can it be an opportunity if you don't know what's going to happen next? As I mentioned, as traders, the one thing we have full control over is how we manage and implement our risk into the market. Now, by doing so, that means you can always pretty much guarantee what your downside will be in the markets. Okay. Just by including a stop loss, you can guarantee what your downside will be in the markets. And if you truly choose to accept that the markets are uncertain, that means your potential upside in any given trade is infinite. It's potentially unlimited. But when you start to open your mind that actually uncertainty can work for you if you position yourselves in ways that you allow the market to run in any intended direction that you're trading a market, then actually uncertainty can be a fantastic thing. Because all you need to do, as I mentioned in my tweet yesterday, your job as a trader is not to sit there trying to predict what is going to happen next. It's to make, yes, calculated assessments based on fundamental and technical analysis that you may have done, but it's simply to manage risk in a way which gives you the chance to place bets, trades in the market that have a very small downside and a very large upside. Okay, so I hope that fully makes sense. So just to recap that section, 3 ways to embrace uncertainty. Exposure. You can't be what you can't see. Go through periods of backtesting and analyze your losses, your drawdown, your win rate, and use that to fuel expectations of what is possible in the markets. Secondly, take back control. Stop thinking that you have full control over what is going to happen in the markets and understand the only thing we can control is our risk. Okay. When you take back control and understand that risk is the only thing within your control, the possibilities become endless because actually you don't care that the markets are uncertain anymore. You know, as long as you position yourself right in the long term, you will come out on top. And the third and final tip, create a perspective shift in your head to understand that uncertainty is not a bad thing in the markets. Uncertainty can be amazing if you are on the right side of it and you position yourself, like we mentioned, in trades which have a small downside and a very large upside. So before we wrap up today's session, I actually want to talk about one important point, which I've mentioned on a few of my calls before, and that is having a plan for what happens when things go wrong. Because everything that we have discussed today in terms of the embrace of the market is all based on the idea of managing our expectations when we actually go live, when we put our position on in the market. Now, why do I say have a plan when everything goes wrong? Simply because we are human. We cannot do certain things in certain situations. We can't foresee everything that will happen. And sometimes it's not always possible to regulate your emotions. So I like to end sections like this by saying, yes, you can do everything you can to prepare yourself internally for what happens in certain situations and make sure you're thinking the right way. But ultimately, there will be a point in time where everything goes wrong. Nothing goes to plan. And in that moment, that is really what's going to define your trading career. Because what you have to understand is in the moments where everything goes wrong are the most important times in your trading. We only have control of our risk. So it's important to have documented what happens if I lose control. What happens if my emotions get the best of me? What happens if I didn't fully prepare myself for this trade and I didn't fully embrace myself for the uncertainty of the market? How do I react in that situation? What happens when an unexpected news event, political event, economic disaster happens in the world? How do I react in that situation? Okay, so have a plan ready on how to manage your emotional responses. And again, this is something that I've done a previous live session on Twitter, discussing reactive ways that you can cope in the moment to help you manage with any emotions that may creep up. So if this is something that's going to benefit you, I would highly recommend finding that previous session and working through the contents of that to make sure that you have a complete plan. You are doing everything within your power to prepare yourself for what is to come, but then also accepting on the flip side that we are not perfect human beings. And it is helpful for me to have a plan B that I can fall back on so that I'm not just shooting from the hip every time something goes wrong. Okay, you have a plan, you fall back on it when you need it, and that is how you keep yourselves afloat. That's how you remain in control. And most importantly, that is how you start to embrace the uncertain nature of the market. And the primary purpose behind doing that is preserving and managing your capital, because that is the most important thing in trading. You'll often hear me say that step one of making money from the markets is not actually calculating how much you can make, it's calculating how much you can lose. Protection of your capital is your first and primary job as a trader. And until you fully embrace this idea that the markets are uncertain, you'll never fully be able to do that. Okay, so watch this session back 2, 3 times, make sure you're taking notes, and actually start to put these exercises in place to help you create that mindset shift for yourself. Okay, so these are just 3 very simple ways to help you understand and embrace uncertainty within the market. And I hope that they are super useful for you guys. I want to wrap up today's session by just doing a live Q&A, which I've been sent a question in, which I promised I would answer on a live call. So I've had a message from an aspiring trader that has mentioned they have a serious habit of hesitating when they need to execute, and they haven't been able to figure out how to break free of this, because in all their testing, from what they've told me, they actually have a very profitable strategy over the long term, but they cannot cut that fear of hesitation as they go to execute. So the advice I would give to you is, the first thing you need to identify is to actually work out what you were afraid of. When you hesitate, what are you actually afraid of in the markets? Because generally in this position, there are 2 things you can be afraid of. You might be afraid of being wrong, or you might be afraid of losing money. That may not apply to you, but in general, those are the 2 most common things that I find traders are struggling with. If you find out in the moment when you hesitate and you think about what you're feeling, if you are afraid of being wrong, that could often indicate that you have a lack of confidence behind what you're doing. And what I suggest for most people, the simplest solution right off the back is to spend more time back testing. Okay. I want you to gather experience, gather data around your edge playing out time and time again, and report back. As I mentioned before, do this over a minimum of the next 100 trades and over a 12-month sample size. Okay. So you ride through many different market conditions. Have a go with that if you have a fear of being wrong, and see how you get on. If your fear is the latter, if you have a fear of losing money, what I would suggest is start by scaling back the account size that you're trading. Because what you need to train yourself to do is execute from a place of process rather than emotion. And where a lot of new traders make the mistake of doing is they actually choose account sizes which they are not emotionally equipped or ready to handle yet. Okay, the analogy that I give most people is, if you had never been to the gym before, would you walk into the gym and try and bench press 100 kilos? You wouldn't do it. It's foolish. Your body is not fully equipped for that yet. So where most people are better off is starting with 10 or 20 kilograms and do it for repetitions. Train yourself up, have more exposure, get stronger. And when the time is right, you start to increase your weight, and eventually you'll be able to bench press 100 kilograms because your body is now prepared. You've given it that experience. Your trading capital is the exact same way. Just because a firm may offer 50, 100, 200,000 pounds accounts, or dollar accounts, I should say, don't think that's what you have to start with. Don't base your decision of what account size to go for based on how much money you would like to be making on a month-to-month basis. So start with a smaller account and scale yourself up slowly. That is the way to truly be comfortable and operate from a place of process rather than emotion, which seems to be holding you back in this particular situation from the hesitation that you have from execution. So I wanted to answer that. I know there are many traders that experience that fear, that hesitation when they go to execute. And this is something that can really help you if you put those 2 things in place. If I've answered your question there, I would love to hear from you. Do this process over the next 2 to 4 weeks. join the Funded Next Discord and online community, and report back with how you actually get on. This is either going to solve your problem entirely, or it's going to allow us to diagnose where we have to go to next to fully resolve your problem. But this is your first starting step. So that brings the end to my session today. I hope you've enjoyed and learned something new, and most importantly, are going to go away from this session and implement something new into your life to help you embrace the uncertain nature of the markets. Thank you very much for tuning in. Be sure you're following myself at Trading in the Now on Twitter, and make sure you're following Funded Next. And we're going to be hosting many more trading psychology sessions. Thank you. Good luck and good trading. Take care.